And here with the latest pulse on the recession expectations is Yahoo Finance's own Jared Blikre. Hey, Jared.
Hi there. Well, I thought I'd take a deep dive into some of these analyst notes that are coming out and pick two of the top ones, Goldman Sachs, JP Morgan. And on Goldman Sachs, this comes from their economic research team, Jan Hatzius and co. And by the way, Brian Sazi is writing this up today. You can read it on the Yahoo Finance homepage. Anyway, Sazi is saying the investment bank, this is Jan Hatzius, now sees a 35% chance of recession in the U.S. in the next 12 months. Now, that's up from 25% previously. And also, only yesterday, Hatzius cut his 2023 GDP forecast by 0.3 percentage points to 1.2%. Now, it's important to point out that in all the economic melee that we've seen happen, or I should say markets melee, it takes a while for that to develop into the economy. And we're not seeing recession risks right now, in other words, in the current quarter, because the economy is still strong. And that's basically what Goldman is saying here. Hatzius thinks that while the banking crisis is a concern, it will not trigger a rate cut from the Federal Reserve. In turn, a recession may unfold as lending standards are tightened and consumers pull back. And here's a key quote from Jan Hatzius. When financial market participants see a higher probability of recession, they are more likely to expect the FOMC to cut the federal fund rates to stimulate the economy. That's what normally happens. The FOMC, the Federal Reserve, and Jay Powell, they respond by cutting rates when they see problems in the economy. Some market participants also expect the FOMC to cut the funds rate down the road in response to falling inflation. However, we are skeptical that it will, and I think that says a lot. Are we not going to get falling inflation? Is the Fed not going to necessarily respond to that because there are other mitigating factors? We'll have to see. Now, the second note comes from JP Morgan. This is their global markets strategy, and they're saying U.S. and global growth, they look firm, but risks are rising as central banks are talking tough. There is a tension between the health and resilience of the global private sector and the shift in the underlying inflation process. Now, this creates pressures which will likely require an early end to the expansion. So early end to the expansions, well, that means recession. Timing the transition from resilience to contraction, which means recession, not easy, but our bias is for this dynamic to take hold later this year at the earliest. Central banks are a key driver of this transition. So later in this year is the earliest they're expecting this recession. Goldman was saying not this year either. After hiking rapidly last year, this has to do with their central banks. We have anticipated a tapering to more modest hikes this quarter as they search for a terminal rate that disinflates without ending the expansion. So they don't think the Fed is done expanding or is done hiking rates yet, much less cutting. They're not even talking about pausing here. So this would be a more hawkish tone that we're seeing from JP Morgan. Also Brian Sazi noting to me, analysts at Cantor Fitzgerald noted Wednesday that the spread between the Fed's funds rate and the that's a two-year Treasury rate, had hit 95 basis points. That level was reached before 3 out of the last 4 recessions. So we've had an inverted yield curve going back, to the middle of last year in the 2s, 10s. Now we're seeing the shorter end of the curve invert too. So some very powerful warning signs on the horizon here.
Indeed, they seem to be increasing every day. A big thank you there, Jared Blikre, there for us.